Hello and welcome to my first weekly fundamentals review. This video is designed to give you a roundup of the past week's fundamentals before looking to the up and coming week at the end of the video. So let's begin. We cannot start talking about markets without looking at one of the key drivers of equities and currencies, and that is commodities. This graph demonstrates why commodities are crucial to our understanding of markets. It is a graph of the IMF Commodity Price Index, and it demonstrates how the total value of commodities has sold off sharply. This has been most predominantly in the energy sector, which covers assets such as oil, which has seen a marked decrease from 200 down to 100, showing a 100% fall in the value of commodities under this sector. This has also been the case for the non-energy commodities, which has seen a fall, which has seen a sharp fall as well. This fall in the price of commodities has seeded into this week, with there being debates over whether commodities have started to rebalance. This is that if they have started to bottom out. The evidence that commodities have started to rebalance has been based on events and expectations that see supply beginning to retract. For instance, last week Glencore announced that it would cut zinc production by a third. This sent the price for the metal up 12%, with it having contagion to other metals such as copper. This contraction of supply has also been forecasted by OPEC in terms of oil. OPEC's view is that the Americans have been pumped out of the markets, in that US companies can no longer afford to keep pumping high amounts of oil. The reason given for this is that the American oil companies have had to take on more debt, as well as the cost of this debt rising as investors become more fearful over the sustainability of oil producing corporation. This can be demonstrated with Denbon Energy Corp bond yields. This graph is shown between the 1st of July and the 16th of October. What we can see is that during the turbulent month of August, which is here, when fear around commodities sent shockwaves through pretty much all of world equities and currencies, the cost of funding for debt for Denbon increased. This shows that investors are less willing to fund these companies, and thus the company might be forced to reduce their production, giving support to the oil price due to a retraction in supply. However, the other side of the debate argues that the floor has not been reached, with the argument based on the view that demand has not come back into the market. This argument has its weight mostly in fears around Chinese demand, as we can see by this table. As what we can see here is that China is one of the world's largest consumer of most commodities, such as coal, where it consumes pretty much the majority of it, aluminium close to 50, nickel close to 50, zinc 45, and copper 45. The fear around China and its demand for commodities was demonstrated on Tuesday when China released its trade data that showed imports fell by 20%. The release led to a fall in the value of commodities as well as in currencies, as seen here on the AUD USD. Just a reminder that commodity currencies are currencies that have large exposure to commodity prices due to them relying on the export of them to fund the nation, such as the AUD USD, which fell 1.62% on the Chinese trade data, and it's this bar here. This brings us on to the S&P 500. Commodities were one of the key macroeconomic drives for the direction of the S&P 500, along with the usual data release. However, there was a further key microeconomic drive, and this was the start of third quarter earnings, with a particular focus this week on banks. It was the interaction of these drives and how they affected expectations for the Fed interest rate that decided the direction of the S&P 500. Fundamental drives kicked off on Tuesday after close. We had both the release of JP Morgan's earnings results as well as trade data out of China. JP Morgan's earnings were released after close on Tuesday. They showed a lower than expected performance for the bank, with earnings per share missing estimates by 7.8%, coming out at $1.32 compared to estimates of $1.38. This was in conjunction with Chinese data rattling investors largely due to the import figure being weaker than expected. This affected the S&P 500 by leading to a sell-off between Tuesday night and into Wednesday, where on Tuesday we had a bounce of the 0.382 fib here, and it fell down to 0.5% fib, which also has been resistance to earlier price action as seen here, and it is at 1990. However, as more negative data came out of the US, such as producer prices showing a fall of 0.5% compared to expected 0%, as well as Goldman Sachs posting a fall in revenue of $1.53 billion from a year earlier, with the revenue figure 3.7% lower than expected, with weak results also being replicated in Hugo Boss, who were hit hard by the slowdown in China, as they recorded a fall in sales, with earnings before investment tax depreciation and amortization down 8%, with earnings before investment tax depreciation and amortization being a guide of how well industries that have invested heavily are doing. These negative fundamentals drive led to the return of bad news is good news for US equities. The reason for the return of this mode of thinking is that investors further pushed out their expectations for a rate hike, with investors pricing in a less than 50% chance of a rate hike by the end of this year. What one can argue then is that the bounce of 1919 seen on Thursday is a continuation of the run seen between the 30th of the 9th 2015 to the 12th of the 10th 2015. Due to it having similar characteristics, being driven by poor data. This run here, the original run, was driven by poor NFP results, leading to investors expecting a rate hike later in the than originally thought. To return to European equities. This is a graph of the DAX, which should be an interesting case this week. This is due to the monetary policy meeting of the ECB on Thursday. There is strong evidence that the ECB is under pressure to do more to help stimulate the European economy. For instance, Elwood Norty sent the price of the euro-dollar sharply lower despite the USD weakening due to Fed interest rate expectations seeing a hike further into the future. Norty commented that the ECB is clearly missing its inflation target. The potential for investors to start pricing in more stimulus could come from the start of next week, with there being an interesting play on the DAX, or German 30 as known on eToro. The DAX has been held down recently by commodity Chinese story due to it having aggravated effect due to Germany being highly dependent on exports. However, it has also had the VW scandal, and I mean scandal. Even China is investigating VW for polluting, showing they must have done something drastically wrong. This has made it so the relative pricing terms the DAX is cheaper than a lot of counterparts. For instance, the CAC or France 40 is at a higher BB, these are Bollinger Bands here, and this is showing it's closer to its 75 mean than the DAX, which is at one standard deviation or one Bollinger Band from its 75 mean. This is also the case for the Espanol 35, which is much closer to its mean than the DAX is, showing the DAX is in relative pricing terms cheaper than its counterparts in Europe. The ECB meets and releases its decision at 12:45 GMT on Thursday, with the press conference at 1:30 GMT on the same day. To turn to the UK now. with this being a chart of the FTSE 100 or UK 100. The UK followed a similar path to that of the S&P 500, although there was not the same element of bad data as good news for equities. This was shown on Tuesday when lower than expected inflation data caused a sell-off in the UK 100. However, this sell-off was reversed when jobs data from the UK came out stronger than expected due to a fall in the unemployment rate from 5.5% to 5.4%. Note this big bar on Wednesday was due to on Thursday, was due to the better than expected data. It has since been tracking the SPX as Federal Reserve is a price maker of interest rates, meaning that it sets rates and the world follows. Thus, the push out in Fed interest expectations pushes out BOE interest rate expectations. Looking forward to the week ahead, we have a big drive at the start of the week, being the Chinese GDP numbers. Here. It is important to note for this data that Premier Lee is targeting real GDP of 7%. This is compared to Barclays, who sees Chinese GDP at 5%. The Barclays figure is calculated through taking the price of copper and dividing it by 1,000. The current price of copper is around 5,000 a ton. The reason there is large disparity between these two figures is that there is belief in the investment community that China manipulates its statistics. What this means for the up-and-coming release is that we are much more likely to see it closer to the 7% target than the 5% of Barclays. This underscores my belief that the release should come out at around market expectations of 6.8%. The reason for this is that if we get a 5%, then the Chinese government will be forced into more stimulus action due to a large reaction by markets, so it would be better for them just to release it closer to their target. To note, however, the Chinese government are targeting real GDP of 7%. This is GDP adjusted for inflation, within which we had lower than expected inflation out of China this week, with the inflation rate at 1.6% compared to the expected 1.8%. This is important as it could be the setting of the manipulation of the statistics, i.e. release lower than actual inflation and higher than expected GDP to give a strong picture of the Chinese economy. Despite these conspiracy theories, the figure is likely to drive markets into Monday. My best advice for the release is to watch the markets as the data is released. This is to see if there is continuation of bad news from the American economy is good news for US equities. Or rather, we go back to the norm of bad equals bad and good equals good. Further, watch if US interest probabilities change throughout the Monday session, as this will be a drive for price action on the S&P 500. The GDP figure is also being released with the industrial production, with there being some case study evidence that the demand for industrial produce has fallen in China. The most recent was a story in the FT this morning, which I've posted a link to in the comments section. However, it notes how industrial producers are lowering prices and having to be more accommodating to buyers, showing weakening demand in this sector. Other important releases this week are on Tuesday we have housing data out of America, which is a strong indicator of how the domestic American economy is doing. We also have the weekly crude oil stock changes that could supply further support to oil prices. The all-important ECB meeting is on Thursday, along with retail sales for the UK release Thursday morning. This wraps it up for this video. Thank you for watching and good trading, happy trading and all that. And if you have any question or comments, please do let me know. Thank you.